I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's show is Brett Barakett, the founder and chief investment officer of Tremblant Capital, a 23-year-old long-short and long-only firm focused on deep fundamental research. Brett works with a senior team that's been together for almost 20 years. He's invested through rising and falling tides in the industry and ups and downs in fund flows. He's also watched many friends and peers retire in that time. Yet he keeps skating to where the puck is going. Our conversation covers Brett's path to launching Tremblant, including lessons from hockey, operational experience, and the early days in a terrible market for the strategy. We discussed the long-short and long-only models, primary research, portfolio construction, sell decisions, risk management, compensation structures, and Tremblant's launch of TOGA, one of the first active ETFs run by a long-standing hedge fund manager. Before we get going, it's time to open the mailbag to share another great story coming out of the podcast. Jim Dunn was a guest way back on episode 24 in the fall of 2017. He reached out last week upon the 10th anniversary of founding Verger Capital with a brief note of thanks for my participation in their celebratory video. What followed is the kind of serendipity that only happens with this incredible platform. Jim wrote, "I also want to thank you for the introduction to Chris Voss you made to me years ago. The podcast and your CIO summit last year led me to lean on his work. Chris unknowingly prepared me to meet a group of protesting students at Wake Forest this week." Jim shared an Instagram photo of an on-campus protest encampment with the words, "The Wake Forest administration has told protesters to dismantle this encampment immediately. We demand in return that the encampment be allowed to move to another location under a guaranteed written contract that we meet with Verger Capital's CIO, Jim Dunn." Jim continued, "Skills like mirroring, the late-night DJ voice, labeling pain, and getting a no were extremely helpful in de-escalating a dangerous situation that, on other campuses across the country, continues." I sent the note to Chris, and he responded quickly with, "Wow, that's incredibly cool. Thanks for sharing, and I'm grateful to know you." Let's just say I'm the grateful one to have a tiny part in connecting great people to share lessons like those Chris brings to the world with leaders like Jim who put it to use. To Jim and Chris and all those impacted, thanks so much for sharing your experiences and spreading the word. Please enjoy my conversation with Brett Barakett. Brett, great to be with you.
Thank you for having me.
Why don't you take me back to the most interesting aspects of your childhood?
Of my childhood, there was a lot of commotion in my house. I think my parents had 5 kids before the age of 25, and we were Canadian, and hockey was very important, and there was a lot of snow, but we had a happy childhood, and I was very close to my siblings and my parents.
What did you take away from hockey?
Everything. Honestly, and I can't exaggerate this enough, so much of what I know about life comes from hockey. All the lessons you learn, you try hard, your teammates are relying on you, you get knocked down, you got to get up. Every shift is a new shift. That's probably one of my favorite ones. All of us have something go wrong in life or go wrong in a hockey game. It's because of you that the puck went in the net against your team. You know what? The next shift is a new game and everything starts again. And I keep learning because I think, I've coached with a bunch of different guys. So like I coach with Chris Drury and I coach with Jack Duffy and I've coached with Mark Messier. And I've learned stuff from those guys. Just the way they think about a little kid's hockey game is so insightful to me. I remember Mark saying to the kids, you got to win every battle. I feel the same way about investing. I got to win every battle, every single thing that you do. And so hockey has been so fundamental in how I think about life.
How about a perspective on growing up in Canada?
Look, Canadians are nice people. It's a beautiful country. People wait by the red light before they cross the street. Education is heavily subsidized. Healthcare is heavily subsidized. Canada is a beautiful, beautiful country with beautiful, beautiful people.
What brought you from the ice rinks in Canada to the U.S.?
Historically, one of Canada's great exports was hockey players. One of my siblings was a particularly good hockey player. He ended up down in the U.S. to play for a U.S. college. One thing led to another, and at some point, he was applying to the Harvard Business School. And he said, you should really consider applying to the Harvard Business School. I was working in Toronto at the time. And when you apply to HBS, there's different rounds, 1, 2, 3, 4. I think he'd been accepted the first round. And it harassed me enough that I eventually applied, I think, the third or fourth round. And so I figured, okay, if I get in, then I'll seriously consider going. And so we both got in. We ended up going the same year at HBS, which was a great experience also for a zillion reasons. But one of them personally is because we went the same year and it gave me a chance to reconnect with my brother for a couple of years.
So how did you find your footing at what you wanted to do in that experience at HBS?
Well, obviously I didn't, because I didn't take investment management. I don't know about your year. So there's a bunch of people who may have applied for the investing course and didn't get in. Doing investing as my occupation was nowhere in my lens. I viewed myself as an operator. That's what I wanted to do from a young age. So even when I was in college, I had no guidance. It's like, okay, what do you want to do when you graduate? I'm like, I don't know. I just know I want to work at a business and eventually one day run a business. And so a professor in college said, well, Procter & Gamble is one of the best run companies in the world. They only promote from within. So go work at Procter & Gamble. They're incented to develop you. If you're any good, they'll make you a brand manager and you'll be running a business. That's what I did. And I became a Procter & Gamble brand manager. And then I got into HBS. I love Procter. Everything I know about life, I learned in the hockey rinks, and everything else I learned at Procter & Gamble. They were a phenomenal company. But at HBS, I decided to try something different. I ended up at Reebok. I had a great experience there. And it was only after I'd been at Reebok for about 3.5 years that the slow wheels in my brain realized, like, wait a minute, there's something else that I see a lot of my peers doing that was interesting. So you go back to, this was the early to mid 90s. As you know, hedge funds were starting to become a thing. And I think in my year, 800 people graduated HBS. I think off the top of my head, I think roughly 2 went into hedge funds. I'm going to get that slightly wrong because Ian McKinnon, but I think he started in 94, 95 with the ZIFs. But you had Chris Shumway, brilliant investor, and my brother Tim, another brilliant investor, were the 2 guys that I remember going to hedge funds. But very quickly, you had a bunch of other guys, Joe Dowling, Scott Baumer, one of my roommates, Mark Bader, going to Capital Group. And so you started to see all these people go into hedge funds. And what was interesting to me was not just that they were making a lot of money, certainly more than I was making at the time, but what was more important to me is what they were doing intellectually every day. It just seemed really interesting. They were looking at the world differently. They were thinking differently. And so I slowly evolved to, I think that's what I want to do, to leap to the end. The reason I still do it today is some people like doing crossword puzzles. To me, this is just doing puzzles. I'm excited to go to work every day and solve another puzzle.
In that period of time, both formative years at Procter and then your time at Reebok, what did you learn from being in operations roles that you might say all these years later, looking at from a perspective of investor, that someone who wasn't in an operating seat might not understand?
Great question. So much. 2 parts. One is just from running a business and how hard it is. In my travels on Wall Street and in finance and sell side and buy side, people's assumptions about, oh, well, you just do this. Take those machines and put them over here. Take the equipment out of wherever, China, and just move it to the Philippines. It's like, it's not that easy. Oh, that's a better product. So just get it listed at retail and off you go. No, you got to go sell it to a bunch of different people. And the creation of product and packaging and manufacturing of it and listing it and convincing consumers to buy, getting the product from the factory to the trunk of your car into your house to use the product and then have you come back to the store and buy it again. That's really, really hard. The other aspect that I learned, and this was all Procter & Gamble, it was just how disciplined they were in executing their business. They hated mistakes. By the time they brought a product to market, they knew it was going to be successful because they had done so much research and had been so disciplined and so methodical about executing it. And so one of the things I learned from them that we still use today is we want to be fact-based decision makers. It's not just your opinion of, my opinion is that stocks can do well. We need judgment in investing, but it's what other research can we do outside of reading the Qs and Ks, building a spreadsheet, talking to the treasurer, CFO, or the IR. That's just table stakes. Now, what can you bring to bear beyond that? And that's where we get creative. And that's been a large aspect of how we invest. And frankly, if somebody looked at our business and said, well, what's one of your competitive advantages? It would be our independent research aspect.
So in those early years, you had this idea because some of your classmates from school were doing this thing that looked interesting. How did you get from you're in this operating role at Reebok to you're going to become an investor?
Not linear. You learn in life that your friends and the people who are close around you, you go to them for advice. And so a lot of people that I've mentioned gave me advice. Try this, talk to this person. My brother was extremely helpful. I have another brother, Peter, who's also very successful, very smart guy. So bit by bit, I started to understand that there was a buy side and there was a sell side. And which would I prefer doing? I was fortunate enough to get offers on both the buy side and sell side early on, but I decided that I should go the sell side so I could learn more about the buy side. So I joined the sell side, and to me, that was a great perch from which to leap. So now I'd go out and meet with all the clients, and then I could decide if A, I want to do that, and B, with who I'd want to do it.
What was that early experience on the sell side like?
Oh, it was wild because I had no clue what I was doing. I'd never worked at a bank. I'd never worked in finance. I was very good at accounting. You know, I'd gone to the Ivy Business School at the University of Western Ontario, phenomenal school. And to do that, they're very rigid about your accounting skill set. And I was good at accounting and I enjoyed it, but I hadn't done that kind of financial math in years. And so to go back to thinking about, okay, how do you calculate working capital again? How do you do days receivable, days inventory, doing all this stuff again, and then just learning who's who, how does it work, is one of these things. I was in the deep end not knowing how to swim, but you eventually figure it out.
What did you learn in being on the sell side that helped inform you later on how people operate on the street?
There's a lot of talking. There's only so much research. So I found that the really well-run buy-side shops did light years more deep research. In my observation, and this is almost 30 years ago, but back then, people did research, but they also spent a lot of time talking to clients. So there's only so much research they could do. And so that was the biggest observation. And actually, flash forward from the sell side and then from ultimately my buy side experience. And the reason I started my own fund is I just want to do it the way I want to do it. There's many paths to the waterfall. There's many different ways you can invest. But I just realized that I just want to do it my way, the way that I invest. I have a very specific process by investing, and that's the only way I believe in. And that was it.
How did you figure out what that way was from the start on the sell side until you started Tremblant?
Observing everybody else and how they did it. And I'd be like, really? Reading charts helps you pick stocks? So telling me that the relative strength indicator is breaking out above the 200-day moving average, and that may work for someone. I'm not disparaging them, but that doesn't work for me. I prefer to figure out a company's competitive advantage and why it's sustainable and how much cash they're going to generate over time and figure out a mathematical valuation and then bring really deep research to bear as to why I think I might be right.
How did you know that it was time to go off on your own?
You start to get frustrated a little bit. The firm that I was at, there was some change going on. I remember I had a conversation with somebody standing on the street in New York, and I said, I know I'm going to launch my own fund. I just don't know if now's the right time. And the quick answer was, there's never a right time, so get going. And I was like, you know what? That's a good answer. And so I got going.
And what was your launch like? You're talking now 2001, so 23 years ago.
Terrifying because I'd taken my life savings and put it into this business. I took down an office space. I got computers, chairs, desks. I hired 5 or 6 people. You had to pay lawyers. You had to open counterparty agreements with all the people on the street. Like, there's a lot that goes into it. And then you had to go raise money. I had a bit of money and I put it in the fund. And my view was, if I could just do 10% on that money a year for the rest of my life, I don't need a lot of money to live on. I'm a pretty simple guy. That was my thinking at the time. And so if no one else invests, I'm good. Number 2 was, separate from that money that I'd put in the fund, I'd invested a chunk of money into all the things, hiring people and desks and all that sort of stuff. And there would be a burn rate. And my view was, when you start a business, how long do you want to fund it for before you pull the plug? Know in advance what the failure plan is. And so what I concluded was that I'd fund the business for 24 months. And if by month 25, I was not cash flow break even, then I should shut down. Interestingly, there was a friend of mine, I won't mention his name, but he started a fund, and about 9-12 months into it, he called me, he said, unfortunately, we're shutting down. I'm like, what are you talking about? Your numbers are good and you got a great process. You're a smart guy. What are you doing? And he said, just tired of arguing with my wife because every month we take money out of our bank account to fund the business. I'm like, but didn't you guys agree on that up front? He's like, no. He goes, I thought we'd raise a bunch of money by month 1 or 2. I was fortunate again that I'd been around smart people like Ivy Business School that they'd coached me on that. That's how you think about starting a business.
So what happened in those first 24 months?
So we started July 1st, 2001. We had just sort of me, my brothers who give me a bit of money. Who else? Bob Jaffe, Glenn Dubin, I think Chris Shumway, Scott Baumer, Joe Dowling. I mean, there's a list of people who give me bits of money. And then we took non-friend and family money August 1. And so I think on August 1st, I think we had 72 million AUM, which was pretty good. I was pretty happy with that. The problem was we had lost money in July. Not that I'm a monthly investor, but I was just so stressed out and obsessive. I just didn't want to let people down. I wasn't scared of failure for my own sake. People believed in me. They gave me their money. I've got to produce. So we lost money in July. We lost money in August. We were losing money in September. And then you found out that 9/11 was happening. And of course, I didn't have a TV set in our office. I didn't watch CNBC. It wasn't what I did. And you found out what was happening. And then it was really bad and really scary. And the market didn't open for a week. And then the markets opened. Then we lost real money. And so it was just really trying and stressful. And I remember one night, I'm walking through Central Park at like 11 o'clock at night, carrying my little briefcase, wearing my suit and tie. And I realized I'm walking through Central Park in the middle of the night, and that's probably not the smartest thing. And I sat down on a bench and I cried. And I was just like, man, I suck. And this is just a disaster. I got up, went home, got up at 6 the next morning, went back to work. Because next shift, just like in hockey, and I'm never going to tap out. If you've seen the movie Officer and a Gentleman, the peak scene where he says, why won't you quit? Because I got nowhere else to go. Burn the ships. That's just the way I was wired. It's like, okay, let's get back in there. And then something really fascinating happened. Look, 9/11 was a horrible thing. The markets did what they did. But we used to call around to the companies, what's going on? What are you seeing? Not, hey, how's the quarter? But just, what's the chatter out there? And one of the retailers told us that paint sales were just exploding. And what do you mean paint sales? Yeah, we have no idea. Paint sales are exploding. We don't know what's going on just in the last 2 weeks. And so we ended up doing a bunch of primary research. And what we realized is that people certainly weren't going on airplanes and they weren't going on cruises. They were staycationing, but they were fixing up their homes. And so it became this thing where people were buying couches and painting their houses and buying flat screen TVs. And so in October of 2001, we bought Best Buy and Williams-Sonoma and all these other retailers and providers that were going to be impacted by this trend. And so in the 6 months of 2001 that we had been in business, we ended up making pretty good money and the market was down. And then that carried over into 2002 where the market was down and we actually delivered. By our 1-year anniversary, we had just under $1 billion AUM and then we grew from there.
So that was turned out to be almost like a golden period for long short investing. What was the business over the next couple of years up until the financial crisis?
Yeah, you're right. It was a good time period to be long and short. There was opportunities on both sides. There were things to do. For me, as a manager, I was young. I don't want to say I was insecure, but I was worried about what I didn't know. All knowledge falls in 3 buckets. I know what I know. I know what I don't know. Third bucket is what I stress about. I don't know what I don't know. That's the part that I was always stressed about. And people would tell you, oh, you should be doing this. And you're like, should I be? We learned a lot, particularly about risk management. I'd buy things and I'd be like, well, that stock's going up. That stock's a great investment. And our hit rate has been quite good, actually. But every now and then we're wrong. And so I learned about, hey, what to do when you might be wrong and how to think about that. And then so 2001 through 2007 into 2008 was fine. And it was really summer of 2007, we started to get nervous about certain things. Way naive, definitely underappreciated the size of the tidal wave that was about to hit us. For example, one of the risks that we as an organization stress about is counterparty risk. And so we started to stress about counterparty risk, particularly as it related to Lehman Brothers. Didn't know anything about Lehman, but we had some of our investors' money there. And in the final decision, it was basically, hey, we don't get paid to take that risk. You may be perfectly fine, whoever was running Lehman at the time, but the risk we get paid to take is what stocks we buy. And I don't get paid to take counterparty risk. So we took all our money out of Lehman, which turned out to be a very good decision. Then 08 hit, and yeah, it got really ugly.
Over the 20-something years since you started, it turned out the long-short bucket was a great bucket to start in. How did you see that change from maybe starting around 08 going forward?
I should have seen it in 01 after 9/11, because that's when they started cutting rates. And then after 08, they really cut rates. And then in COVID, man, they really cut rates. And so if you just sort of looked and said, it's easy with the benefit of hindsight, right? There's going to be inflation. And so when money's for free and there's no rebate anymore, particularly after 08, in hindsight, long short to a degree became less attractive. And, in hindsight, long only has become more attractive, as evidenced by the markets have gone up quite a bit. For us, the long only strategy that we decided to get in was quite simple. I was in a room with a bunch of guys and Steve Mandel mentioned that Lone Pine was going to launch a long only fund. I was like, why would you do that? That doesn't make any sense. Put it in context, I think Steve's a genius. He's one of my favorite people on the planet. I think he's so smart, so thoughtful, and such a nice guy. He's talking about launching this long only fund. I'm like, but you're going to suck up your liquidity in your big positions for a product that is lower margin. That doesn't make any sense to me. But I was like, man, but he's a really smart guy. And I kept pondering that. And then bit by bit, people would say, hey, do you have a long only fund? Hey, do you have a long only fund? And then we had one client, a guy named Matt Stefan, and he calls me, he says, hey, I just got this new job and they put me in charge of long only. And I want to invest with hedge fund guys who have long only funds. Do you have a long only fund? I said, Matt, we're launching one tomorrow. Well, I didn't say I was investing in it. I was just saying, do you have one? I said, but no, Matt, we're going to launch it tomorrow. And so we did. In 2011, we launched this long only strategy and we went from there.
So once you introduced the long strategy, I'm curious to get your thoughts now about the validity of long short.
Because they've been cutting rates since 9/11 at a rate and to a level that none of us ever could have predicted, shorting became less and less attractive. The market just kept plowing ahead for a bunch of reasons. The debate now is, why would you want long short? Well, now there's finally a real cost of capital again. And we think it's a phenomenal shorting environment. Why? Because there's a whole bunch of people that are carrying a ton of debt that was basically for free, which is not for free anymore. And so what we believe is there'll be a culling of the winners and losers. The strong will get stronger and the weak will get weaker. The strong balance sheets will get stronger and the weak balance sheets will get weaker. I do think there's a world, given what we see today, that makes a lot of sense for long short. That might change again. If all of a sudden something happens, they blow up buildings and we start cutting rates to zero again. Now we've learned a lesson that long short might not be the most attractive place. But as it stands now, long short I think is very attractive.
What have you learned over the years about the types of short positions that work for you?
I love smoking gun shorts. When you find that smoking gun in the accounting where you're like, wait a minute, they changed the depreciable life of their average asset from, I'm making it up, 10 years to 20 years in the course of the year. Why would they do that? If they hadn't done that, what would their earnings have been? So you look at that and you say, okay, that's a smoking gun. I got you. Or you told me you rented a car for, what'd you pay, $45 to rent your car for the day? I'm like, it was a really nice car. And I'm like, we're now working on, is there a short in the rental business? Because if that's the price, that's not normal. Just in your travels all the time, we come across stuff and you go, oh, that's interesting. That's different than what I thought. I should follow up on that.
I'd love to circle back to the investing underneath what's going on in the business. How did you describe the investment strategy of Tremblant?
I want to compound my own capital. That's been my North Star since we started, which is what would I want to do with my money? The process by which we invest falls into the following 4 parts. Number 1 is an assessment of the business model. So it's basically if you brought McKinsey into a business and said, hey, is this a good or bad business? What would they do? And this is overly simplified, but basically they'd say, okay, what product or service does that business offer? What competitive advantage do they have relative to their competitive set? And is that competitive advantage sustainable over time? Michael Porter, buyer power, supplier power, these types of things. But basically that's the idea, is competitive advantage and why is it sustainable? Part 2 would be assessment of the financial model. And here, to make it a little more colorful, what I say is, hey, Ted, how about we give you the financial statements of a company? We'll white out the name of the company so you can't see what company it is or what industry it is, but we'll just give you the income statement, balance sheet, and cash flow. You have 15 minutes to tell us whether or not it's a good business or bad business, just based off of the financials. Okay, that's a good exercise. So what would you look at? Well, I'd look at cash flow. How much cash is being spit out of the business? What's being reinvested back into the business to have it grow? What's left over is free cash flow. And then how are they allocating that free cash flow? Number two, I'd look at the returns on invested capital. So let's take two examples. General Motors has a lot of CapEx. And so ROIC is lower than, say, Nike, which has almost no CapEx because they outsource all the production to somebody else. So we look at ROIC, and then we would look at what we call the ROIIC, the return on the incremental invested capital, so that the incremental dollar bill that's being reinvested into the business is at a higher or lower rate than the prior business. You'd look at what we call QOE, quality of earnings. GAAP accounting, GAAP accounting, is assumption-based. Now, in the real world, we're cash people. Well, I bought that piece of equipment for, $100,000. I paid $100,000. Well, in GAAP accounting, we then get to choose whether we depreciate that piece of equipment over 5, 10, or 20 years. And depending on what you choose will impact your GAAP EPS. So if I choose 20 years, well, my earnings will be higher than if I chose 5 years. Well, as analysts, we just want to make sure we're understanding what assumptions were made and bringing everything back to cash accounting. And then finally would be valuation. Okay, what kind of cash do I think they're going to generate out into the future, bring it back, discount back today, and compare that to our stock. So business model assessment, financial model assessment. Third is we want to know what's changed. So what is changing in the world, or what has changed in this company, or what has changed in this company's industry set that will tell us why this is interesting now. It's an old example, but for those of us over the age of 30, might remember Blockbuster. When we started back in 01, I can't tell you how many deep value guys you got to own Blockbuster. It trades at 5 times free cash flow. It's just so cheap. Well, obviously things were changing and Blockbuster ceased to exist. I mean, Blockbuster traded 3 to 5 times free cash flow until it went to zero. And so you got to look at change, and change comes in many ways. It could be something as simple as a new product launch, or it can be a competitor that launched a new product. It could be AT&T, Verizon, T-Mobile, and Sprint, which is a 4-player oligopoly. All of a sudden, Sprint and T-Mobile merge, and now it's a 3-player oligopoly. So the competitive dynamic changed. It could be a new CEO comes in, a new CEO has a new strategy. It could be a new CFO comes in and they have a new financial strategy and things that they want to focus on. It could just be, we saw them very recently, both with Elon Musk and X and with Zuckerberg and Meta, 2 great examples of CEOs saying, yeah, we don't need to spend all this money. What did X go from 8,000 employees down to 2? Right? And so I think so many companies were like, wait a minute. Yeah, we don't need all these people. So the cash flow that then spits out the other side. And then the last part, which is probably the most important, goes back to what I said about being fact-based decision makers, is what independent research can we bring to bear that is outside of the financial statements, outside of normal financial analyst work, that we can bring to bear that would help us make a decision here. And that's where we spend a lot of time.
So within all of those lenses, a business model, financial model, consequential change, and the research you can bring to bear, what's the sweet spot of what you like to find in a long position?
All of them. In a perfect world, you'd find a company where something changed. You would say, well, the moat around their competitive advantage has just increased. I love when people say like, oh, back in the day, Amazon trades at 150 times earnings and they don't generate any cash. And I'm like, what are you talking about? They're generating an insane amount of cash. They're just reinvesting it all back in the business. So we love finding things like that. There's some controversy. So we try to isolate, we try to figure out that one factor. Chris Shumway gave me great advice years ago. He's like, you're not going to outmodel the other guy. We're going to build models. Figure out the one driver that will dictate success or failure to your thesis, and then spend all your time on that one thing. And that's what we try to do.
So in that last piece, that incremental research, I'd love to hear the evolution of what did that look like 20 years ago, and what does it look like today?
So different. It's incredible, the power of technology and how it's changed that aspect of what we do. So you go way back, even before I started Tremblant, when I was working at another hedge fund. It wasn't like I had some like big idea. To me, it was just like, well, I got to do this. So there was a company called Abercrombie & Fitch, the retailer. And I thought Mike Jeffries was a brilliant CEO. I thought his product was great. I thought he had found a real niche for what he was doing. And so I did the model and I said, oh, these guys are going to bang out stores. So what we call the self-funded in retail investing, meaning that they're generating enough cash from the existing store base to open new stores. So the self-funded organic grower. So let's say that they're going to grow the store base 10 or 15% a year, and then they're going to put another 10 or 15% same store sale on top of that. So then you're going to get to a 25, 30% top line, and then they're going to get leverage. So that's really attractive because if you get a good retailer that can do that, that can grow for a long period of time. So I thought Abercrombie was going to be that. But part of my analysis was, okay, I got to get to stores. So I spend part of my day going out to Abercrombie's and asking certain questions. And then I realized maybe if I hire 2 or 3 high school, college kids in different geographies of the country, it could lever my time. So pretty much every Thursday or Friday, I would call them and say, hey, listen, I need you to visit 5 stores over this weekend. And it's really simple. Here's what I want you to do. I want you to go find Abercrombie. I want you to walk in and I want you to find an associate on the floor and ask simple questions. Hey, are you getting more hours or less hours? Are you guys looking to hire more associates or are you firing associates? Hey, did you get the new line in? When did you get in? 2 weeks ago? How's it selling? Oh, you've already sold out half the line? Or, hey, you got in 2 weeks ago and half the line's already 80% marked down? These types of questions. Look around the store. With the best guess, just eyeballing it, is 20% of the store on 20% markdown or is 80% of the store on 80% markdown? And so it was that simplistic that we would just visit stores. And so Abercrombie at one point became somewhat controversial and the stock went up and then went down a lot. And I just maintained my conviction because I had enough data points from on the ground showing that Abercrombie was actually selling really well. And one of the small pieces that became controversial was people go in the stores and be like, hey, half the store is empty. They've got an inventory issue. Well, what it became was, no, half the store is empty because they sold out everything at full price. And so that was independent research back then.
And how's that changed over the years?
So you can still do that, and we do some of that. But now so much is sold online. The world has changed. We can scrape and create web bots that get so much information for us, which is rather than a small sample set, a big sample set. And so we can get so much more data from that kind of thing. And then you layer on top of that survey work. 23 years ago when we started the fund, you actually had to gather the people. Today, hey, I want this demographic, this income level, this age group, and this type of job. And you can get a database really quickly. And even now, I'm still a little suspect on this. AI can do that for you. You can say, tell me what 18 to 24-year-olds would think about this brand or this product. And the AI will tell you. I'm still old school enough. I want to do the survey. I want to ask actual people as opposed to the AI telling me what it thinks.
How did you sense over the years that the market was either incorporating or not incorporating this type of varying information? So it's boots on the ground 20 years ago, and now you're looking at your computer and web scraping and checking in on AI.
You have to do both. So we have plenty of examples on investments over time where we would just go out to the stores. You would survey a bunch of doctors. You could do a survey where somebody fills out a multiple choice questionnaire. But a lot of times more valuable surveys are, hey, can I ask you a few questions? And you just ask them, hey, what do you think of this? What do you think of that? But like all things in this world, there's shared learning, but there's also a lot of copycat. And so people talk and they're like, oh, how did you figure out how to do that? Oh, you visit stores, huh? Well, we should visit stores too. And then things morph. And so what we used to call independent research or fact-based decision-making then morphed into this thing called data sciences. So you look at now the world of data sciences. I think you can get master's degrees in data sciences now. Obviously, 10 years ago, you couldn't. Why? There's so much data now, and everybody is trying to stay one step ahead of everybody else. So everybody knows you can buy credit card data. Everybody knows you can buy weather pattern data. Everybody knows you can buy satellites looking at parking lots. I mean, this stuff has been well written about. Some of that is useless. Some of that is useful. A lot of it needs to be overlaid with each other. So looking at the parking lot today versus exactly 1 year ago, may be completely useless depending on what the weather was like the prior year, whether it was raining or sunny, what the holiday was Easter earlier or later that month. So these things, they get complicated very quickly. The last piece I would say is I remember talking to somebody who has a very large organization and they talked about big data and we were talking about data lakes. They were going on about their ability to scrape their data. We are the opposite. We talk about little data. We want to go find that one thing that's going to drive success or failure and bring a lot to bear on that one thing. And that is where we spend all of our time.
How do you think about the importance and assessment of management teams in your companies?
My wife, Megan, says all the time, how you do one thing is how you do all things. If you're polluting rivers behind your factory, I can only imagine what else you're doing if you're cheating in other parts of your life. So yeah, this is critical. Look, not everybody's squeaky clean. One of my brothers, Peter, runs a business called DDC, Due Diligence Consulting. We hire him all the time to do background checks on management teams. There was one company we were invested in a number of years ago where I just didn't feel good about the CEO. I mean, I know it's ridiculous, but I just had a bad feeling. And so we spent a fortune doing a background check on the CEO and CFO of this company. It was what I call a yellow flag. There was no red smoking gun, but there was enough there that we cut back the position. And it turned out that we were right. There was a problem and the stock was a fraud. We're lucky that we had cut back the position. So yeah, how you do one thing is how you do all things is a great way to assess not just management teams, but also investment managers. I don't know why you would ever put serious capital with an investment manager that you didn't do a deep dive on their background.
Once you've eliminated certain management teams because of, say, yellow flags, maybe red flags, how do you assess the quality of a management team in the companies that you're interested in?
You want to see talent. The same thing you would look for in an investment manager. You want to see grit. You want to see that they're driven. There's a track record of success. There's a lot of smart people. The prettiest guy in tryouts for the hockey team, that's one thing. But when the puck drops, you see who can actually put the puck in the net. And those are the guys you want. Some guys decompose when the game starts. And then obviously alignment of interests. How much stock do you own? I love sitting with management teams and we get in this conversation about how much stock do you own? What do you think your stock is worth? Why? Well, here's what I think. Sometimes I think I'm crazy. And it's like, okay, let's debate it over time. But now we're aligned. That's how I do it.
Are there any things that you saw from your operating experience back in the Procter and Reebok days that give you some lens into deciding if the management team are better or worse than somebody else might think?
I have to admit, I love CEOs or senior executives who know the granularity of their business because they love it. Jim Sinegal, who used to be the CEO of Costco, you meet with that guy and you walk around a Costco with him, he is just locked in. He is taking notes. He's asking you questions. I can't remember what store it was. I think it was in Long Island. I shopped at a Costco and I mentioned to him that the shopping carts, the wheels were busted on a bunch of them and that they didn't roll that well. I think a month later, I was back at that Costco, all brand new shopping carts. Jim Sinegal is so maniacal. Galanti, the CFO at Costco, who just retired. I mean, that guy knew his business backwards and forwards. It's always concerning to me when you talk to someone senior at a company and they don't know some degree of granularity.
How do you weigh the quality of management when you're looking at the business model, the financial model, the dislocation or change in the types of companies you like to buy?
That's a very good question. It's a threshold. It has to be above something, and then everything else is just benefit. And then we focus on the other things. Because at the end of the day, whether it's the industry sector, the product, new product launches, there's some dynamic that we think is going to drive this forward. That's most important to us. Without naming names, you can look back over the last 10, 20 years, 30 years, companies that had to step on the competition and gave it up because they just didn't execute. We've made a few mistakes. BlackBerry. By the way, have you seen the movie? The movie's hysterical. A little too close to home because we made a bunch of money in BlackBerry and then we lost a bunch of money in BlackBerry. We were early. One of my partners was like, this mobility thing is going to scale much faster than people think. And the winners are going to be Apple and Google and BlackBerry. And the losers are going to be Nokia and Sony. And so we had the longs and the shorts. And at first we did well on all of the pieces except BlackBerry. And you look back and it's like, yeah, they were skating a little too fast. So yeah, that comes down to management.
How do you go from incorporating all those bits of research into making a decision about a stock?
Well, there becomes judgment. As you know, thousands of people graduate from top schools every year and come into the money management industry, and there's very few who can generate alpha. So it's very, very difficult. And so, yeah, there is a degree of judgment. There is a degree of, I'll call it artistry. There was one senior person at Endowment who shared with me, you can play the notes on the instrument, but I don't hear music. And that's a great line. And I think that's the same thing with investing. You can have all the tools and, everybody knows how to build an Excel spreadsheet and do a DCF and overlay a Michael Porter analysis. And okay, I'll get some data sciences work. But in the final analysis, it's the judgment. And it's not easy. It takes time to find out if you have it.
How do you assimilate all that information to get to the point where you're ready to express your judgment about this is a buy, this is a sell, a certain position size?
We use a phrase here. We say, it should be obvious and compelling to all. So meaning that we're not interested in good ideas. Like, hey, I think if this, and this happens, we can make 15%. It's like, well, that's good. But we're long-term investors. And so we're looking for things that we think can double or more in 3 years or less. Okay. When you start saying, well, I need 20, 25%, it's like, okay, what do you see that is different than what anyone else sees? And is that realistic? And by the time the research is done, our investment committees and the people I work with, my partners, we've been together for a very long period of time. And so we create a culture where we can openly debate, and guys get angry sometimes. It's like any family. By the time somebody expresses something and everyone's, well, did you think of this? And what about that? And what research did you do on this piece? By the time it's done, most of the people in the room are kind of nodding their head going, yeah, that sounds pretty good. I'd like to buy some of that too. That's usually what we come to. And then in terms of sizing, the second part of your question, there's many paths to the waterfall. Some people love having really concentrated portfolios. I'm going to own 5 stocks. I'm like, well, good for you. And that works when it works. But when it doesn't work, I don't want my brain melting down. Other people like, I want to own 50 or 75 or 100 stocks. I'm like, well, how much do you really know about 100 stocks? Or how much deep work are you doing on 100 stocks? So for me, 20, 25 names is probably about right. We can do a lot of research. So you say, well, we should have 2 to 4% positions. We don't really outsize massively anything. A big position for us might be 5%. Why? Because I want to make my money on my hit rate. I know a lot of people talk about slugging and knowing when to take the really big bet, but sometimes you're wrong. And sometimes it's not that you're wrong on the fundamentals. Sometimes the stock just goes in the opposite direction. I could give you lots of examples of that where we were right over time. So what dictates whether something's 2, 3, 4%, or maybe in a blue moon 5% is 1, obviously the liquidity of the stock. 2, what do we think the risk reward is? So the stock's at 20 and we think it can go to 40. And if we're wrong, we think it goes to 18 or we think it goes to 2. So that ratio. And then lastly, what do we think we know relative to everybody else? What independent work have we done that we think gives us an edge on everybody else? So roughly about a third of the time, we do independent research that we think is really impressive. It's like, man, we really know a lot more than other people. And we've had conversations with investors come in, they're like, we just left so-and-so's shop and their biggest short is your biggest long. And I'd be like, okay. And we'd pull out our independent report and I'd say, do they have this information? And we'd go through page by page and they'd be like, wow, okay, no, they didn't. So independent research, about a third of the time, we're like, wow, we've got some really good stuff. Another third of the time, we're like, yeah, we got some stuff. Might be good, better than nothing, but it's not heavy. And a third of the time, it's like, we have no freaking idea. Like we're making not a judgment call, but we really like the position. We think we've done good, normal, fundamental analytical work, but we really don't have anything extra. And an easy example on this one would be like, okay, Ted, we're going to get long Coca-Cola. All right, you and I can go to as many stores we want and count as many cans of Coca-Cola. It's not going to give us any advantage. There's no value in that.
How do you think about in a market where, say, the tech sector, you got the Mag 7, some of the stocks that have some of the characteristics you talk about, great business model, great financial metrics, are doing well. It's very hard to know anything different from anyone else about a Google, for example.
So you can have an analytical edge. You could also have a perspective edge. So a good example of this was back in the day, there was a perspective that Amazon was a good short because they didn't generate any cash. The PE ratio, which we think is useless, was infinite. But there was a shift in their business model that was so obvious to us. And we realized a well-known hedge fund investor wrote how it was a big short of his, Amazon. And I read the letter and I'm like, oh my God, we're not big enough on the long side in Amazon. Why? The individual is a very smart investor who I have massive respect for. They missed that Amazon was changing their business. So Amazon originally was basically, you would buy toothpaste from Amazon. Amazon had bought toothpaste from Procter & Gamble. They held it in their warehouse and they shipped you a tube of toothpaste. But what they had shifted was fulfilled by Amazon and third party. So meaning that Ted Seides would order toothpaste from Amazon. Amazon would route the order to Colgate. Colgate would ship you the toothpaste. We don't have any inventory. We don't have inventory risk, no shrinkage, no carrying cost. And then Colgate would pay us, I'm exaggerating, I don't think it was Colgate, but other suppliers, and they would just pay you the 15% fee. Well, that's an infinite ROIC. They're just using your website. The other one that they had also done was fulfilled by Amazon. So meaning you would order the toothpaste and the toothpaste company kept their toothpaste in Amazon's warehouse and we would just send them the tube of toothpaste, but the inventory was not our problem. Like if it didn't sell, you're taking it back. And so when you look at the 2 additional ways they start selling to consumers, well, that just exploded the returns on capital in the business. And then the other factor, which we see now in a few businesses we're involved in, is people are way underestimating the advertising potential of business. And we saw that in Amazon. way back when, before Amazon was even really advertising or reporting it as a line item, we were like, oh my God, people are missing. Amazon's not going to be doing billions in advertising revenue. They're going to be doing tens of billions and ultimately over 100 billion a year in ad revenue. Why? This is why I learned at Procter & Gamble. Targeted marketing is the most valuable information. Back in the day when we were kids, Ted, Nielsen would say, oh, the Cites household, what are they watching on TV? What magazines are they getting at home? Okay, now we can figure out, we can create sort of a scatter plot of what they're going to buy. When you know exactly what someone's buying, you're Amazon, you have all the information. We know you buy Colgate, Ted. Well, now that information to an advertiser is infinitely more valuable than scattershot because now they can target you. And as we all now know, the joke is, oh, my phone's listening to me because I talked about buying a new pair of Hokas and, next thing you know, I go on Instagram and there's an ad for Hoka, or whatever. It gets really complicated quickly, but you can still have a perspective insight into the investment.
How do you think about sell decisions?
Oh, very simple. You sell when it hits your price target and nothing else has changed. It feels good when it goes up. I think it's going to go higher. Really? Your opinion? Or is that a fact-based decision? You got to be fact-based. You got to stay rigid. So you said the stock was at 20 and you thought it was going to 40 and now it's at 40 and nothing in your model has changed. We're selling the stock 100%. The other reason you sell a stock is something in your thesis changed. You said you thought it was going from 20 to 40 and here are the inputs to the model. We're quantitative people. One of those inputs just changed because something changed. Sell the stock. And the best part is we don't need to debate it. Just sell it. And if tomorrow you want to buy back the entire position because you rethought about it, fine. We're highly liquid. In what we do, everything's infinitely liquid. We're not in privates.
How do you go about making decisions for the portfolio?
This is so critical to how we've had success, but also how we've had success retaining talent, is if you have somebody who you developed over time, ultimately they want to make the decision. What I found is people who are talented don't want to keep going to the quote head person and saying, hey, I think we should buy da-da-da. And the person who spent 300 hours on it is saying, hey, this is really compelling. And the head guy's like, nah, I don't feel like buying that day. The person's eventually going to get frustrated and leave. I mentioned earlier, Mark Bader, he was a Navy SEAL. He's a close friend and he's one of my heroes. He had this thing, always go with local intel. Like, yes, always go with the person who's done all the work. Now you can disagree because you feel they missed something in the research or you want them to spend more time on it. So I have the ability to say, nah, can we hold off on that? Can we have another conversation about it? But I see everything we do. I'm a large investor in the fund, and so I want to know what we're doing with my money. But the people who are in the portfolio manager seats, they're managing positions for the entire portfolio. These are not carve-outs. It's, hey, you're going to take a 2 to 4% position for the firm, and you're going to decide when to do that, and you're going to put the order in, and then you're going to manage it. What we've always done is, another Procter & Gamble thing is, you can't evaluate what you don't measure, therefore measure everything. And how we measure it is, it was your idea, air quotes, you were the trader. You were the one who decided us to buy it. It's one thing that you were the analyst on it, but someone else in the organization said, oh yeah, that's a great idea. We're going to buy it because you didn't want to buy it. You get partial credit for that. But where we put a lot of value is you did great analytical work and you executed the trade and ultimately exited the trade. I hate to say trade because these are investments, but you decide at some point to get out of it or not. We owned one stock, great company in Germany called Eventum. They're a ticketing company. So think Ticketmaster, but better run in Europe. And we owned that stock, I think, for 15 years contiguously. That was a phenomenal investment by one of our PMs.
How do you think about risk and risk management?
When we talk about managing risk, I want to make sure we're clear that we want to manage the risk of real capital loss, that we're going to lose real money, as opposed to just managing the volatility. So the way I look at risk is it falls into 5 buckets. The first level is what I call the fundamental risk of the stock we're buying. So that does not include necessarily the beta of the stock. We'll look at the balance sheet, we'll look at insider ownership, we'll look at a bunch of factors that tells us how fundamentally risky is this. So for example, I think Credit Suisse, before it went bankrupt, had a beta of 1. And I think Silicon Valley Bank had a beta of 1.2. So not that risky. They both went to 0. If you looked at the fundamental risk of Credit Suisse, if you didn't look at the beta and you just looked at the fundamental risk, you'd be like, a lot of leverage. You would have said, that's a pretty risky business. Maybe insiders owned a bit of stock. I don't know, but it's probably all options. Did anyone actually go out with their own money and buy stock? I don't know. When we first got involved in a company called Skechers, its beta was, I think, 1.3 or 1.4. But if you ignored the vol of the stock, you said, 25% of the market cap is net cash on the balance sheet. That's pretty good. 25% of the stock is owned by insiders, by management. That's pretty good. Just those simple things. You'd say, that's not that risky. I feel pretty good about owning that. Maybe the stock might bounce around a lot, but point to point, it becomes this thing. I don't know a lot of people who measure the Sharpe ratio of their personal account. So level 1 is the fundamental risk. Level 2 is now you put together a bunch of individual stocks. That is important to look at the quantitative risk metrics. And I think that we have an incredibly advanced risk engine that we developed over time. It started in 2006, but it really accelerated. We had a big drawdown in the fall of 2008. And so we developed this risk engine. We had a risk team. We ended up retaining a guy named Ken Grant, who used to be the head of risk at SAC, used to be the head of risk at Tudor Corp. And he's an advisor to us. He sits in on all our risk meetings. And so that's where you look at the risk factors, vol, VAR, beta, IVAR, all these things. We think we have an excellent risk engine of how you're putting these pieces together, making sure there's correlation stuff. The other 3 are ones that people don't talk enough about. Number 3 is counterparty risk. We took our money away from Lehman Brothers in the summer of 2007. We measure the risk of our counterparties. Very simple. We look at the CDS of anybody who holds our clients' money. If the CDS goes above a certain level, we pull our money. There's no conversation. We do not get paid to take that risk. We need counterparties as part of our business, but I don't get paid to take counterparty risk. And so we will not take counterparty risk. We need to manage the operational risks of our business. Number 4 is what I call investor risk. Who you're taking on as your clients. There's people out there, they lever their money, they do certain things. So we need to make sure that we have a client base who deeply understands what we do and is deeply aligned with it. They'll understand that we will have drawdowns, that things will bounce around. We might not generate alpha for a period of time, years, but over time, we usually find our way there. We've never had gates on our strategies. We don't need them because we're super liquid. For the right partner, they like that idea. And then last and finally is what I call risk of ourselves. We run a business. We have a management company. We have employees. And so we need to make sure, just like we look at our investments, what cash do we hold on our balance sheet? How long can we pay the bills in a worst case scenario? What kind of leases do we sign? What kind of lease terms, counterparty terms, employee contracts? All these things are important, but that's a level of risk. So what we call the 5 levels of risk, that's how we think about risk.
How do you organize the investment team?
PM based. So we think about industry sectors because there is expertise. We don't have a healthcare area. You would imagine if you want to look at healthcare companies, knowing the healthcare space would be pretty good. Obviously, knowing the retail space. We have very broad brushes. So retail consumer, we have what I call TMTI, tech, media, telecom, internet. We have like software, industrials, these types of things. And I think it's really important to have really broad spaces. So for example, I suppose at a very large investment organization, you would get a job there, Ted, and they'd say, Ted, you're the US restaurant analyst. Well, guess what? You're going to find 5 restaurants that you think are great investments. This is the way things go. Here, we don't want you to do that. We want to say, Ted, you're the global consumer and retail analyst. As I said earlier, we own 25, maybe 30 stocks, and our holding period is usually 2 to 3 years on a name. And so we need you to come up with 1, maybe 2 great ideas a year. Okay, you got the entire world to look. That changes your lens. It changes what you're looking for in a really healthy way.
How do you and the team think about that competition for capital to get at those 25, 30 names?
Because of how we compensate people, they're incented so that if you have a better idea than I do, you can have more capital. As I said earlier, our best ideas should be obvious and compelling to all. So if someone else at the table is like, yeah, you know, my stuff's good, but it's not great, but man, your stuff is really good. Everybody at the firm gets paid first on how we perform for our clients. And secondly, on their relative contribution to that performance. But the first part is so important because everybody's aligned to have the best outcome for the firm or for the clients first. Without that, you end up a mercenary type organization where people are trying to box out, oh no, I'm covering that stock or that's my name, or they don't want to share information. We don't want that. And that's not a culture I would want to work in anyway.
So over the years with the senior team that's been with you for a long time for most of this run, where did you come to in terms of the balance of the compensation that's based on how the firm's doing as a whole and the compensation based on the relative performance of the individual?
I looked at other models. I looked at how other funds managed it, and everybody's got their way. That works for them. But I just kept thinking, for me, I wanted everyone focused on the main outcome, which is the client, the investor who entrusts us with their money. The outcome for that entity should be our number one focus. And so how do you align incentives around that? And 2, that's just a culture I'd rather work in. And then 3 is, I observed that a lot of funds had this thing where they'd have a partnership agreement and so would have this type of economics, a percentage of the profitability or something like that. But I was always like, but what if that person quits, or what if they get fired? Or better yet, what if they don't quit or don't get fired, but they come in late, they leave early, they take a long lunch? Where's the incentive mechanism on that? And I realized, explaining internally and debating it at length with people, is that the people who perform, the people who are truly driven, will do better economically over time if we don't have people having a click on the switch, because somebody exits a firm and they were getting X% of the economics, and then there's a bleed out for a number of years where, 3 or 5 years where they get some portion of those economics. You have enough of that, and then the people who are staying, the ones who are the performers, are like, okay, well, why should I hang around? I'm not going to get paid for 3 years. So we've eliminated that.
In addition to that alignment with compensation, what have you done in managing this team of talent so that the senior people have stayed for so long? Because you're in this situation where you've had a long run, but you're not necessarily the biggest fund with the most economics to pay out.
We're doing it the way that we enjoy. I mean, it depends what your goal is in life. But I think that we've created a culture. By culture, I don't mean like, oh, we're all like buddies and we sing songs on Tuesday nights. I mean like a culture where we don't lie, cheat, or steal. We think we do really good work, where we treat other people with respect. Another lesson I learned from Procter & Gamble, you're going to get judged here on 2 things. 1, on your commercial performance, and 2, how you develop people. You cannot get promoted here unless you can show that you're developing people, because we want to develop talent internally, and that's worked out really well for us over time. And I think that people want to work in an organization like that. Ultimately, there's always somebody who can offer you more money. Anybody has a job anywhere in America. Somebody can come along and offer you more than you're making now. But will you be happier? We want to make sure that once you find a place that you're happy at, yeah, I'm pretty happy here and they pay me pretty well, so I'll stay.
Now in the business, you started as a hedge fund, had this long-only strategy. I know recently you've launched this TOGA, an active ETF, and would love to hear about that product. Why did you go into this sort of new vehicle for you guys?
My North Star since I started the business has always been, what do I want to do with my money? So the day I started on July 1st, 2001 is, what do I want to do with my money? What I've learned across all these decades is the markets are generally efficient. And every now and then something happens either in the markets or on a stock specific basis, and there's a dislocation. And at that moment, the thing that's guided me is, what do I want to do with my money? So along the way, I've always had money in our different products, but to some degree, there's tax friction. Somebody subscribes, somebody redeems, a PM trims 50 basis points, another PM adds 50 basis points. So there's like a little friction. And you think about that compared to your personal account. A lot of people have PAs and they buy stocks there. And so we developed TOGA because what I realized, and with the help of one of my partners, is that the ETF structure is massively tax efficient. So it's even better than your PA. Why? Let's say you bought Microsoft in your PA and over time it doubled. Well, you may want to sell it. Well, now you sell it, you owe capital gains tax. And I should have known this. I actually didn't fully understand it. The brilliance of the ETF structure led by Vanguard is create a structure that we can own Microsoft. We don't, but we can own Microsoft and TOGA. It can double. We could sell Microsoft, and the owners of TOGA won't pay the capital gains tax until they sell their share of TOGA. That's brilliant. So I was like, well, that's better than my PA. I want to put my money in TOGA. And so that's how the idea started. But then as I thought more about it, I was like, but why would anyone else be interested in it? Well, other people, I'm sure, like the tax efficiency of the ETF structure. But then, I was thinking, well, it's perfectly liquid. So when you invest with a manager, you've got to fill out a subdoc and you got to give 30 or 60 days notice when you want your money back. Here, it trades like a stock. ETFs trade 9:30 to 4 every day. Perfectly transparent. You got to post all the positions at night. Ease of use, but you're also not waiting around for a K1. It's anonymous. A lot of personal friends and stuff, people in the industry have money in our strategies. But here, I won't know if they invest, but even better, I won't know when they redeem, right? So it makes it really good. And the last part, and this is really important, there's no discount to NAV. So unlike a closed-end fund where you go buy that closed-end fund, now you want to sell it. You got to find someone who wants to buy it. ETFs don't work that way. There's this creation redemption structure where if we own these 40 stocks and you buy a share of TOGA, you're going to get pro rata these pieces of 40 stocks. And you can hold that for a year, 10 years, 50 years. And then when you go sell it, then they decompose it and hand you back your money. So it's brilliant. So we thought it was brilliant for my personal money and also brilliant for the underlying investor. It's different than our other strategies, but we thought it was a brilliant product. And so that's why we launched it.
What have you heard from other peers or people you've talked to when you start discussing the active ETF structure?
So it seems to be a fairly new thing, even though ETFs have been around for a long time. I think what happened was Vanguard was the brains behind creating this structure. I'm not an ETF expert, but my understanding is the government sued Vanguard saying, hey, wait a minute, you're doing something wrong here. And Vanguard won the case, I think 3 or 4 years ago. In 2023, 600 billion, big number, flowed out of mutual funds and almost 600 billion flowed into ETFs. But there's not a lot of active ETFs. And so, yeah, now when I talk to people about it who are in the industry, they kind of squint at me. At first, they're glassy-eyed because they think I'm selling them something. And I'm like, look, I don't care whether you ever buy it or not. But number two is I'll never know. So like, it doesn't matter. When they finally focus in on it, really smart people, they go, huh, that's really smart. And I'm like, okay, great. And so I think there is a lot more conversation around active ETFs from people who look like us, start as long, short funds, this kind of stuff. I think you'll see a lot more. I don't know why you wouldn't, because for your own money, it makes too much sense.
I'd love to ask you about, of all these friends you've had, people in and around the industry, what are some of the key lessons you've learned from some others?
There's different ways in today's world of learning, but one of the oldest ways of learning is just talking to your peers. Michael Porter has this statement that he made years ago where he says, people ask the question, why is it that most of the world's, I'm making it up, high-end leather handbags come from these 3 towns in the French-Italian Alps? Well, he calls it circles of excellence. People talk, well, how did you do that? Why that? And so I've just been very fortunate. I know a lot of friends who are just phenomenal investors. And so I've learned from them. But I've also been lucky that my mentor, I met this guy, Charlie Ellis, who I know you know because he's been on your podcast more than once. And from your time at Yale Investment Office, Charlie is just unbelievable. I can't be more like Charlie because I'm not smart enough. But if I could be more like Charlie in life, that would be my goal. He's just so thoughtful, so smart, so articulate, and just a nice guy. And I was fortunate to meet him because I received this fellowship when I was at the Harvard Business School that him and 2 other guys funded. It's called the LME, the LeBaron MacArthur Ellis Fellowship. It was the largest pool of capital to people who needed money to go to school. But over time, I think over the last 30 or 40 years, it's been the number one contributor to helping people pay for the school. And so I met Charlie that way. And at first, I met him to thank him for the money. And then, I don't know, a year or 2 later, I said, hey, I reached out to him, hey, I could use some advice. I asked him a few questions and he was really nice about it and gave me really good advice. Called him again another year or 2 later and they said, oh, why don't we meet for breakfast? Why don't we meet for a coffee? Bit by bit. I mean, he's just such an incredible human being. I've learned so much from Charlie about not just investing, but about life and how to conduct yourself, how to be a person of integrity and how to look out for other people. Phenomenal.
If you circle back to where you started at business school, a lot of the people that you mentioned that were in the business, Chris Shumway, your brother, are no longer still actively managing money for other people. I'd love to ask why, through all these trials and tribulations over the last 23 years, you are still so deep in the game when some of your peers aren't or are doing it in a different way.
Everybody gets to live their life. This is what I enjoy doing. Not a Maslow's hierarchy of needs, but like what makes me happy? Well, number one, spending time with my wife, Megan, makes me really happy. Spending time with my children makes me really happy, whether it's coaching their hockey teams or something like that, or taking my son to the park, goes down the slide. That brings me joy. So spending time with my family is the thing I enjoy most. And then the next level would be looking at puzzles, like investments. I just enjoy that. For somebody else, they'd be like, God, what a boring guy. Well, that's your choice. Some people like going to new restaurants and they like traveling the world to try new things. And they like going to rock concerts. They like going to black tie events. Hey, we all get to live our life as we want. And that's what you choose to do. That's your choice. So live your best life as you choose. This is how I choose.
When you look structurally at just doing what you've liked for so long, and then again, some of your peers who I imagine have similar interests, why do you think you've had the duration that others chose not to continue on that path?
It wasn't that they couldn't continue on that path. They just chose that there were other things that were interesting to them. I think, though, the answer to the question you're asking is around balance. And I think that this applies not just to our industry, but to life. And too many people overdo things. You just got to stay balanced and you got to decide what's important to you. And that's how I choose to live my life.
A couple of years ago, you moved down to Florida, and there's been a lot of movement of people who maybe used to be in the Northeast or down in Florida. Would love to hear your thoughts on investing from down in Florida compared to where you were before.
Well, it's not just about investing. It's about what's going on down here. It's been a massive upside surprise. Why? One, the dynamism that's down here. So in the financial services industry, I'm amazed at how many people that are in the industry are down here, and you feed off each other. And within that, I read an interesting statistic a few weeks ago that made sense to me, but I didn't think of it this way. 2/3 of the people living in Florida are from somewhere else. The Floridians, in air quotes, are in the minority. Hence the reason there's so much dynamism here. Number two is this place just works well. The airports, the trains, the highways, things definitely work down here. And my last one, I remember when I first started opening down here, I get a call. Hi, I'm Kelly Smallridge. I work at the Palm Beach Business Development Council. I'm like, okay, how can I help you? No, I'm here to help you. What do you need? I'm like, all right, what do you want? You want me to write a check to something? I don't understand. And she's like, no. I'm here to help you. I'm like, look, I don't need to pay you for that. She goes, no, I'm paid for by the government. I'm here to help you build your business. She says, if you need office space, you call me. If you need employees, you call me. If you need access to the universities, you call me. Whatever you need, I'm here for you. Here's my mobile number. Oh, and the mayor of West Palm Beach wants to meet you tomorrow for a cup of coffee. I mean, it was astounding. I am so impressed by how things run down here. Look, not everything's perfect. Sometimes the bridges go up. It gets hot in the summer. Florida has been a significant upside surprise.
All right, Brett, I want to get a chance to ask you a couple closing questions. What is your favorite hobby or activity outside of work and family?
I like spending time with my wife, Megan. I like spending time with my kids. I like solving investment puzzles, and I like playing in the odd game of hockey.
What's one fact that you find interesting that most people don't know about you?
Other than I'm bald. Look, I'm vegan. I'm like 99% vegan. I might have an egg once in a while or a piece of fish once in a while. I just feel better that way. It's not for everybody. It works for me.
And where'd that come from for you?
I did a bunch of research. My brother, Tim, was one of the first people to mention it to me. And then I spent a lot of time studying a guy named Caldwell Esselstyn, Yale guy, doctor, Olympic gold medalist in rowing. He was the head of heart surgery at Cleveland Clinic. So there's been a bunch of stuff out there that he has said. And then there's other people who followed, Dr. Michael Greger and others. For me, that's worked. That's how I got there. It was a health choice.
What's your biggest pet peeve?
I love everybody. At this point, people do what they do, and I just smile. Somebody drives too slow, they cut me off. At this stage of my life, I just smile. I'm like, okay, the guy's in a rush. Somebody gives me a finger for cutting me off. I'm like, okay, he doesn't know me. I think at this stage of my life, I look back at my own life, and my pet peeve is probably my own thing, which is, in my youth, I probably wasted too much time. Not that I was in a rush, but wasting time on things that didn't matter, time and energy. If I had to pick one, it would probably be that. It's just, I don't want to spend time on things that don't matter.
How about on the investment side?
There are certain things that I'm like, that's just not relevant. We'll interview somebody and, well, what do you think of that? And at some point they'll say, and the chart looks really good. Or they'll say the PEG ratio is X. And I'm like, PEG ratio? Like really? But that's okay. It doesn't drive me nuts, but I'm just like, yeah, that's not that relevant to me. Or when someone says, well, we think they're going to beat the quarter by a penny. And I'm like, okay, it's just not that valuable to me.
Which two people have had the biggest impact on your professional life?
I think it would be impossible to say just two. So I'll give you sort of hierarchy. Absolutely, number one is my wife, Megan. I am very fortunate that I met Megan. I look back, we may have talked about the movie Slumdog Millionaire. Certain things just happen in life and you're like, okay, why did that happen? And it's a whole other long story about how I met Megan and how she came into my life and my children's life. But I just am very fortunate. Number two is both my brothers, Peter and Tim. I mean, I had a gift that they were my siblings as opposed to somebody else. They're both just very smart, industrious, but they just have good judgment. They know how to put the puck in the net. And I was lucky. And then number three is Charlie Ellis. I can't even begin to explain how lucky I was. We could have a whole separate podcast just raving about Charlie. Number four, my partners that work here. I learn from them all the time. They challenge me. They get up in my grill. I'm better because of them. If they weren't here, I wouldn't be as good. And I hope they would say the same thing about me. The other bucket, which we've talked about, is a string of guys that have had great success in the investment business who also happen to be good friends. The list is so long. And I've just been so fortunate to, have had these people in my life. That's what I would say.
What's the best advice you ever received?
Who you pick as your life partner is really the most important decision you're ever going to make in your life. You pick poorly, man, that ain't fun. You pick well, and you and I probably have a lot of friends that we can see it. Did you pick well or did you get lucky? I know some people who met their wives when they were 19, 20 years old and they're still together. And best decision they ever made. Were they smart in doing that? I don't know, but they got it right.
All right, Brett, last one. What life lesson have you learned that you wish you knew a lot earlier in life?
So I would repeat the same thing, the life partner one. The one I'm going to say is way too easy. It's a marathon, not a sprint. And that applies in so many aspects. So when I was younger, I was always in a rush. The world did not move fast enough. And that's okay. I'm happy with how things turned out, but you got to have balance and just don't do things that are going to damage you. And I would say this about your life, your personal life, about your physical body, and about investing. You could take that one big bet. I can put all chips on red. Even if I had great information that I'm going to be right, but you never know. We got invested in Apple in January of 2004. It was our largest position for years. In October of 2008, the stock fell 50% and stayed there for 6 months. If you had all your money in Apple, I don't know that you could have survived that. There was a great article written years ago about Amazon that if you had bought in day one, you would have made a ton of money, but you would have lost your mind in the process. And so just stay balanced. That to me is probably the best advice.
Brett, thanks so much for taking the time, for sharing all this great experience and wisdom you have.
Thank you, Ted. Thanks for your time.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.